If you own a US dollar denominated bond or dollars or whatever, you can deposit it into the substitution fund, and then the IMF can determine, well, they'll convert them into SDR denominated fiat assets, and then they can determine or they think they can anyway, the timing of when that comes back to the US to the final destruction of whatever itty bitty bit of purchasing power yet might remain in the US dollar at that point. So you need to care about this, because this is going to impact your life, your children's life, your children's children's life, and so on and so forth, and so on and so forth. And if you are not in the right position as we go through this, you know, it's a big club, and you and I are not invited. But let's create our own club. How about we do that? This is the reason that they give for this huge allocation and distribution of brand new SDRs that are created with a button push, right? The global supply of reserve assets could become more constrained over the long term. Really? Okay. Well, let's look at that, because they show in there, this is G7, so the top 7 economies, the government debt as a percentage of GDP, which is 140% and continuing to grow, right? We're going to raise the debt ceiling. I mean, this happens every time. Either they're going to suspend it or they're going to raise it. They'll probably suspend it, because then there's no limitations on how much they can spend until it comes up again. And then also major central banks' balance sheet as a percentage of GDP. And we're talking global here. Can you see the problem? And if you can't, what the real problem is here is that there comes a point where debt is not just unsustainable, but actually has the reverse impact. And we are there. That's why all of this new money creation, all this new debt creation that has been happening, particularly since 2008, has not been effective in really growing the real economy. Now, growing billionaires' economy, absolutely. Growing the stock market and all of these bubbles, absolutely. But really, there's been a small number of people that have benefited compared to the many. As the central banks, as the Federal Reserve began quantitative easing, which is massive money printing, in March of 2009, that's when that started, and you see where the SDRs came out. And this is what just is happening. I mean, it goes into effect in about another week. Yeah, about another week. Okay, so you can see that this dwarfs what was happening, what they did in 2009. And that was in the middle of a crisis scenario. And this is also, when I re-looked at this, and what they're saying here, US 650 billion general SDR allocation, so they just push a button, create it, and then give it to everybody, would help meet a long-term global need for reserve assets. And there's part of me that goes, yeah, because this wasn't enough. You know, 140% of GDP, I mean, just keep printing that money, just keep taking on that debt. And then that's when it hit me when I looked at it. Are we in crisis? 100% we're in crisis. There's not one doubt about it. I don't give a crap what they tell you. Their actions tell me they are trying to battle this huge crisis. We are in crisis. The wheels are falling off the bus. What they have done, all of their experiments are not working. But what I also see here, especially when they're talking about the long-term global need for reserve assets, is I see the positioning of the SDR as the world reserve currency. I mean, honestly, it always made sense to me because since it's a basket of currencies, there are no limitations to how many currencies they can put in that basket. So that, I mean, it really does make sense to be a global currency that can be converted into the local currency. So US dollars or euros or yen or what have you, because it's part of that basket. But you also have to wonder about the impact on you and me. So I believe that what we're looking at here is twofold. Number one, it's crisis because they're not saying, well, we're going to issue this in the long term. No, they're issuing them this month. So whenever anything major, whether you realize it's major or not, but they know that it's major, they know what they're doing. They have a plan. I hope you do too, because they have a plan. Then what do? They dumperooski gold and silver. We're going to talk about that in a second. But before we do, let's just look at the value of bar and coin demand in the first half. H1 is the first half of the year, so January to June. Highest since 2013. 2013, there was an awful lot of confidence that was lost because we were still so close to 2008. And people saw who was chosen as too big to fail, and it wasn't us little guys. And nobody went to jail because those contracts are written in such a way that what they did, disgusting, despicable, evil, not illegal, which is what counts in a court of law. Maybe. I mean, let's face it, there are different rules. QE began in 2009. I'm going to be talking a lot more about that when I do the Bank of England thing. 2013, a taper tantrum created market volatility. So you see all of the accumulation in the public buying gold because this is bar and coin demand, right? Well, people are uncomfortable again, and that's between January and June, first half. They should be. My daddy always said, do what I say and not what I do. I'm so grateful for those words. Because I look at what they say, everything's hunky-dory. Don't have to worry about a thing. We've got it covered. This isn't going to create inflation. And the inflation is transitory. Don't protect yourself. Let's do a big dumperooski on gold and silver so people think, oh no, it's going down. Are you kidding me? Flipping gift.